Hello, a very good evening to everyone, and welcome to the OTCS Market Outlook 2023. And my name is Richard, and I'll be your host for today. And before we start, can you please, if you have not already joined the Telegram channels of the media partners and our speakers, please join the Telegram channels that you see on the screen right now. Okay, so I'll flash this again later. So let me now begin. Now, how is the market so far? Last year, I think the S&P 500 has spent a large part of the year dropping. Right? It's very, very obvious on hindsight. So this chart to me says it, tell me a few stories. So you can see that the red line is connecting the tops, and then we kind of poked through a little bit in the last couple of days, and then we fell under the trend line again. So, and the good thing is that it is SPX is above the 50-day and 200-day moving averages. So that's a good sign. And then we are now in an symmetrical triangle. So symmetrical triangles means the downtrend has stopped because we have formed a higher low, but we are still stuck under the lower high. So depending on where SPX were to go, whether it break above the symmetrical triangle or it breaks below the symmetrical triangle, then I think the direction for the next couple of weeks would be in that direction where the breakout happens. Okay, so that is, in my opinion, where the market is at the moment. So depending on what is your preference on reading the market, you can also draw your own conclusions. So to me, we are in the market where we are at a traffic junction. So want to turn up or down? I think this week we will have some better clarity. Okay, because tomorrow we have the FOMC meeting, and then the next day on Thursday we have the big earnings coming from the Amazon, Google, and Apple. All right. So, well, tonight I'm not the expert. The experts are the speakers that we have invited to share with you their outlook for the coming year. But before we begin, please allow me to introduce to you OTCS. OTCS stands for Online Traders Club Singapore, and we are a non-profit society formed in 2005, and we are a community of traders and investors. To me, OTCS is a place where we network, share, and learn, and we do it through a series of workshops, webinars, such as the one you are attending right now, and courses, and our library. For workshops and webinars, we aim to have about 6 to 10 a year. It is free for our members. And for now, because of the COVID situation, we are holding it entirely online and it's entirely free for everyone. And this is one of our last few in-person seminars that we have held at the SGX Auditorium because they are our venue sponsor, and it was very well attended back in 2020. For courses, we aim to have 2 to 4 a year, and we will normally do a group buy to bargain with the course provider to give better rates for our members. And we aim to have about 2 to 4 a year. As for our library, we have over $6,000 worth of resources in our physical library. So for our members who want to know what they are, you can go to our website and download the PDF. So in summary, to me, OTCS is a place where we network, share, and learn, and we do it through a series of workshops, webinars, courses, and our library. The normal price to be our member is $120 a year, but for a time limited period only, it is $60. And right now, it is entirely free. So to learn more about our society, please go to our website, onlinetradersclub.org. Okay, so if you want to be kept posted of our upcoming workshops or courses, please remember to join our Telegram channel. It is not a group chat, so it won't be noisy, only for announcements. So if you prefer to have our email, so please join our mailing list. And right now, I would like to take a few moments to thank the OTCS crew, who are also our members, who is working behind the scenes to help us out during our physical seminars. So you know who you are, and we thank you for helping us to run the show as well. And now, the very important slide, the disclaimer. You are responsible for your own profits and losses. The speaker's opinions are their own and does not represent OTCS opinions. OTCS, its office holders, associates, sponsors are not responsible nor liable for your losses. OTCS events are for educational purposes only and should not be construed as advice. And when you're in doubt, please seek professional help. And with that out of the way, let me now flash these slides again in case you have just joined us. Please support our supporters of our club by joining our the Telegram channel so that you can be kept posted on the various updates from our media partners and our speakers. Okay, and tonight we have invited three industry experts to share with us about the US markets, the bonds market, and Singapore REITs. And there will be a Q&A after each speaker. So while you are listening to the speaker, you can type in your questions in the chat box that you see on the screen at the bottom right if you're using a desktop computer. And if you're using a mobile device, then you may need to scroll up or down to look for the chat box. And I will ask the speakers at the end of their sharing on your behalf. Okay, so please feel free to type in the questions along the way if you have any. And with that, I'd like to welcome the first speaker, Mr. James Yeo, to share with us about the US market. James, I'll hand over the stage to you now. Yes, I can see you. You may need to unmute yourself. Yes,
Hello.
good. Yes.
Hi. Okay, good. Everyone can see me? Can you hear me? Okay.
Yes.
So let me share my screen right now.
Sure.
Yeah. Okay, can you see my slide?
Not yet.
Oh, not yet.
Just give it a few more moments to load. Nothing yet? Maybe you want to...
Nothing.
Yeah, try again.
Oh, okay. Give me a second. Can you see my slides now?
Nope.
Huh? No?
Not yet. Now it's still at the sharing.
Yeah, I already clicked the start slideshow.
No, not you're not sharing your screen yet. Maybe you try again. Okay, try
Okay.
again. Now says
Give me a
screen
second,
loading.
Okay, how about now?
Okay, let's give it 5 to 10 seconds. Still nothing.
Nothing.
This is despite us doing our tech trial. Interesting.
Yeah.
Yeah, no worries, no worries. Do you share the whole screen or you're sharing just a
Never mind, I
window?
can share my whole screen now because I was sharing the Google Chrome. Give me a second.
Okay.
Yeah, I'm sharing my entire screen now. Is this okay?
Okay, let's wait for a while.
This is my entire screen.
Still not loading. Just now, did Chrome prompt you for permission? Oh, no need. When we do a dry run just now. Okay, let's try again. Sorry, everyone. A bit of technical issues, despite us practicing before the session starts.
Yeah.
Yeah.
Sharing blocked by my browser. Says sharing is blocked.
That means just now, maybe you
Okay,
have
now?
to.
How about now?
Wait,
I can see it on the live webinar itself. You can't see it?
Yeah, I can't see it.
Anyone else
Maybe
can
you want to
see
start
it?
to. You want to restart the browser or something?
Restart the browser.
Yeah,
So I
that's one
rejoin
way.
now.
Alternatively, is you send me the slides and I'll share from my side while I'll be your slide clicker. That's one way.
I close and then I join back.
Okay, can.
Yeah, I think faster.
Can.
Richard,
Yes.
the alternative is for me to, if he still cannot get it, if James cannot get it, maybe I can go ahead first.
Okay, we let him try one more time.
Yeah, can.
Okay, can. James, go ahead and try.
Yeah, it's currently loading.
Oh.
I'm not sure why. I cannot stop sharing.
Oh, interesting.
Yeah. Or why not Yen go first now? Cannot cross it.
奇怪哦。Ian, you want to try to share your screen and see whether anything appears?
Okay.
Okay, just now mine appears.
Sorry. Let me try one more time.
You try one more time.
Last time. Yeah.
Your James, you're using Google Slides, right?
Yeah, Google Slides.
Okay. Later, if cannot, you send me the link, then I'll share from my screen.
Okay. Can you
Yeah.
see it now?
Let's wait for a while. Let's give it 10 seconds.
And then, I think Yen can go first.
Okay, can. James, later you send me the link to your slides. Yeah.
Okay.
Share to my Gmail.
Okay.
Okay, Ian. Thank you for stepping in.
Moment.
Can.
Maybe James can reboot his computer.
Yeah, while
Right.
yeah, later on, wait,
Yeah.
please reboot your computer also.
I am getting ready. Hold on.
Can.
Okay. Okay, I started to share. Can you all see?
Okay, let's give it 10 seconds to load. Still nothing yet.
Still nothing.
Okay, I see the slide.
You see the slide, is it?
Yes.
Okay. Let me move to the next slide and
I also loaded your slide on my screen, so in case can be your clicker.
okay.
Do you move to the next slide
Yeah,
already?
yeah. I am moving the slide. So do you see it moving?
Yes. Ian Low, market outlook.
Yeah. So now it's at the market outlook.
Yes.
Okay.
Yes.
So
You move your arrow to the corner.
yeah. So now
Okay.
my arrow is in the middle now. Okay. So I start.
Yes. Thank you, Ian. So Ian will
Okay.
cover bonds.
uh, thank you everyone and good evening and 恭喜发财 to everyone. All right, so it's so close to New Year and I could barely find the time to prepare for this presentation, but I spent the last 3 days day and night preparing for it. Okay, I shall start first. All right, and okay, let me see. Is everything okay? All right. So please join my website or my mailing list. All right. And you will receive my exclusive insights and updates. And I will also put up my slide here, my slide onto the website too. All right. So please subscribe. And I have only 30 minutes today, so forgive me if I speak very fast to cover all my slides. Today's today's focus is going to be on corporate bonds. Okay, focus on corporate bonds. In fact, I don't want to shortchange you guys on REITs and shares. So in 2 weeks' time, I plan to have another webinar just like this, only for REITs and shares. Today, I'll cover a bit on that, but mainly focus on corporate bonds. Okay. If you are lost and do not know what to invest with all this news on COVID, inflation, interest rate rising, I hope this short talk today will give you some ideas. I'm Ian Low. For those who do not know me, I invest primarily for passive income, corporate bonds, REITs. All right. I'm a remisier with Maybank Securities. No longer called Maybank Kim Eng, it's called Maybank Securities now. All right. I'm also the secretary of Online Traders Club. All right. All trading has risk. So whatever I tell you today, you can lose money. Okay. So it's not my intention to ask you to buy any stocks or bonds today, but I'm simply sharing with you my 2023 plan. What stocks I plan to buy for myself. All right. This slide shows the performance of the market in 2022. Okay. Look at the US stock market in 2020. We were all bashed. All right. Now, can you guys remember what happened in 2021? 2021 US market was the best market. And in 2022, they were the worst, practically the worst market. All right. So that's how things are. Now, what is surprising about this slide? I asking a question, but I cannot see you guys answer, but never mind, I'll tell you the answer. Every market is a minus, but Singapore is a plus. Singapore is the best performing market, plus 4.1% in 2022. Now, the crazy thing is, Singapore market is not just 4.1% because it's what you measure by charts, all right? It's actually 8.4. How did I get that? They paid out the STI paid out 4.3% dividends. 4.1 plus 4.3 is 8.4%. Singapore market performed 8.4% 2022. That's incredible, all right? Incredible considering it's a terrible market. Singapore is boring but stable. Now, in fact, my whole slide today and in 2 weeks' time is primarily focused on Singapore. And this is the reason why I think Singapore is doing well now, because we were refined by the baptism of fire of the pandemic. The strong will become stronger, the weak will become weaker. You know, it's the same for REITs or shares. When a when the price start falling, they become a penny stock. It's very hard for them to recover again. So during a difficult time, the weak will fall, the strong will become stronger. And Singapore definitely has become a stronger market. All right. Now, in 2023, this is the performance of the stock market so far. Every country is a plus, all right? It's a plus, especially it's a China, especially Hong Kong, all right? Singapore is just 4.5, but you know what? We are slow and steady. We are stable. All right, 2023 things. In fact, if you forget everything, to me, this is the most important slide today. That this is the theme that the way I see it for 2023. It is really a slide on. It's really a market where we look at inflation and interest rates, corporate earnings, which may have a possible recession, and the tourism resumption and China reopening after the pandemic. So why is it so important? If we can find counters or stock to take advantage of the direction of these trends, and even better, what if our stock can meet all our views with all three? That means a counter that can meet all three. All right, that's the best. All right. Will the Fed pivot interest rates? Meaning, are we seeing the end of the interest rate cycle? The Fed fund rate right now is about 4.5%. You guys can see that this is the currently we are here now, and it's forecasted to go up to 5 and slightly above 5. So for the early part of the first half or the first quarter of this year, for example, tomorrow is the FOMC already. All right. Now, likely there's going to be a 0.25% increase. In about March 15, there may likely going to be another 0.25% increase again. All right. So the Fed fund rate will likely peak at 5% and hold steady for the 2023. That's what the analysts are telling us. All right. But you know what? The analysts are also speculating that the inflation will fall because as the economies reopen, the supply chain disruption get less, supply chain improve. You see, we are here now. It is forecasted to go down, but in 2024, it's back to 2%. All right. Are the analysts right? We do not know, but we seem to be on the crux of a possible pivot. How long this pivot lasts? Is it this quarter or this year? But we are on the crux of a pivot now. Now, how do position for the fall of interest rates and inflation? All right. Now, the REITs underperformed STI last year by 19%. That means that STI, we are slightly up, but the REITs performed worse than STI by 19%. They were bashed. All right. Now, I believe that if the interest rates and inflation start falling, REITs are one of those which may rise in price. All right. I believe it's time to increase exposure to REITs and corporate bond perps. When I repeat, is increase exposure, not to buy up everything, not to buy everything now, but to increase your exposure because prices now for REITs and corporate perps are very good. Forgive me, you hear my kids talking, they are in the background, all right? Okay, now, reasons for investing in REITs. Right now is the best time if the Fed stop hiking. And I believe it pays to be early than to invest later. That is my preference, all right? I think we should be early. We can, of course, later we can be more secure and sure, but then the price may already gone up. Right now, the price is decent. It's good to go in early a bit. Not everything. Not show hand, but to go in a bit. Especially go for high quality REITs that has emerged stronger after the test of fire. If you realize the high quality REITs I've been studying them lately. They have become stronger. The weaker REITs, the smaller cap REITs, they have become weaker. All right. And in 2022 and 2023, there is limited supply of logistics, office, and retail shops in Singapore. Okay. Now, what are the REITs that we should look for in this market? What are its criteria? Watch out for my webinar in 2 weeks' time. All right. I'll be sharing this slide in a couple of days on my website. You can have the full slide way before my webinar, but watch out for it. Let me move on with my webinar. All right. Now, the other theme, the second theme that is happening is China is fully open. Why do I say that? Not question. The first thing on December 28th of December 2022, the National Immigration Administration of China announced that it will resume approving Chinese citizen application or passport for tourism and visiting friends abroad. That means from 8th of January, they will start approving a shopping passports for travel of Chinese national to overseas. All right. So the shares now are rocketing. Second thing, this is very fresh news. Fresh out the news from China is that for this Chinese New Year, 300 million trips by plane, 300 million trips was made in Chinese New Year this year. This is 90% of pre-pandemic levels. Pre-pandemic is 90%. So I think China is fully open now. What has they done? They have reversed their policy 100%. This came out in today's Straits Times. If you today's article, all right, Xi Jinping did 100% policy reversal recently. He lifted property regulation. He lifted tech regulation. He lifted zero COVID policy. He encouraged tourism to go in and out. Education stocks have also doubled in China. Now, the Chinese prime rate, unlike the US, US is going up, right? The Chinese prime rate is forecasted to go down this year. All right, to go down lower this year. The inflation rate is forecasted to go higher for China, but not much higher. It is what they are used to in China. All right, so this is a part where it is going up this year. One more thing, this came out in the Straits Times recently that our STB, Singapore Tourism Board, projects for 2023 that that arrivals into Singapore will grow for 6.3 million in 2022 to 12 to 14 million in 2023. That means double. They are going to double the visitor arrivals in 2023. All right. And not only that, they are going to set aside 500 million to boost this industry in 2023. All right. They're going to spend and they're on major events that's planned this year. How can Singapore benefit? Well, if you just take a look at this, 2019, before the pandemic, 19 million tourists visited Singapore. In 2022, 6.3 million tourists visited Singapore. This is last year, all right? 2023 is going to more than double, all right? This is the forecast now. Not only tourists, general tourists, but also, let's look at China now. In 2019, 3.6 million China tourists visited Singapore. 2022, only 0.06 million, all right? That was last year. Very little. And now they are going to chop passport to allow travel for tourism. This year, we do not know how many tourists is coming from China, all right? Okay, so what are the counters that will likely catch the China win? And all right, watch out for my webinar in 2 weeks' time. Okay. Now, what are the risks? Possibility of US recession. All right. This is the first risk. US GDP growth is expected to be less than 1% this year. Let's look at China. China forecasted to be about 5%, all right, this year. One country less than one country 5, one country is dipping, another country going up, possibly a recession in the US. I think for this year, forgive me, James, I do not know what is your talk later, James, but maybe it's shorting, but I think this year may be the year for China, all right? Now this is if this happen, escalation of war beyond Ukraine, this is a major risk. If this happen, hey, of course, my bullish stance will be different. Okay, so I'll be sharing this in 2 weeks' time, but this is how I plan to do it. All right, with the bullish stance on China and how I plan to trade the stocks there, I would trade is to use moving averages. For example, 8 and 12 moving averages crossover to trade stocks rising on uptrend. All right. So it's to trade the uptrend for the bullishness in China now, not to buy and hold and invest. All right. You see, in the trending market, we should use a trending indicator. So right now, China is trending. We should use a trending indicator. All right. If we are investing, for example, for the long run, then I will not use a trending indicator. All right, I'll cover this in 2 weeks' time. Now, what are the Singapore counters that are defensive? Not only defensive, but also defensive and yet catch the China wind and yet take advantage of the interest rate falling. This is what I'll cover in 2 weeks' time again. All right. And now, finally, I have moved on. I have 15 minutes to cover my favorite corporate bonds. All right. Corporate bonds is preferred over equities, over REITs. If you ask me whether to buy REIT or bonds in this market, I will choose bonds. Why? Let me give you the reason why. You see, there's upside for REITs, upside for shares this year, but there's also a risk of recession. There's also the Ukraine-Russia war. There's still risk. So, in a recession, bonds will be more resilient than equities. This is the one. You see, in a recession, likely the US will drop interest rate to fight the recession. And when interest rates fall, bond prices will rise. All right, this will be fastest react. So I prefer bonds to equities. All right. Now let me give you some trends for corporate bond trends in 2023. First thing, the worst may be over with inflation tapering. Secondly, when recession happens, credit risk may increase. All right. That means that companies may become weaker. The weaker global outlook likely will reduce new bond issuance. So like this year, like last year, there will be very few new bond issuances. That means if you want to buy bonds, likely it has to be through the secondary market. And that's what I'm covering today. Perpetuals may not be called as seen in the recent non-calls. All right. So if you look at the analyst report for this year for corporate bonds, almost every house is saying that for bonds, perps are a risk because they see perps not being called. All right. And today I'm going to share with you for a 15 minutes study on perpetuals. And we are going to study what happened in 2022, what were the perps that were called, what were not called, and try to position ourselves to look for good perpetuals that have good returns that will be called. And if it's not called, it will reset to a high coupon. All right. Now, if you if you are like some of my clients who say that I only want straight bonds, I don't want no perps. Yeah, it's fine. You can only go for straight bonds, but I can tell you that straight bonds returns is only like 4% right now. So if you buy a straight bond, the return is about 4%, which is as good as buying T-bills. All right, so you must have go and buy a T-bill. All right, so there is no advantage in buying a straight bond now in this market. Unless, of course, you buy a straight bond, for example, that mature in 10 years. All right, because they don't have T-bills like that. So if you're for 1 year, you want low risk, assured, you want a sure 4%, go and buy T-bills. Don't need to go and buy corporate bonds. All right, perpetuals. This is what I'm covering today. Now, the first thing is let's look at the perps that are not called in 2022. All right. So last year, what are the perps not called? All right. The first I'll look at is there were call dates, perps with call dates last year, but they only have the terms that reset in 2027, 2028. All right. So last year, Maple Tree 3.95% perp wasn't called. It continued at 3.95%. There was no reset. StarHub 3.95 continues with no reset. Wing Tai 4.35% continue with no reset because there is no reset till 2027. All right. So it's normal, it's natural. So there's a good reason why they didn't call. Because the reset is later. Now, we also look at right now, the original coupon resets to a lower coupon. All right. Now, soy build at 6%, after a reset, they pay lower. First read, after a reset, they pay lower. Frankly, in this market, soy build and first read, to me, they make the right call. They are paying a lower coupon, so they do not reset. So they have a good reason. They have a good reason not to reset. And after all, they are not the top companies anyway, so they chose not to reset. All right. Now, Escort from 4.68 reset to 3.07. Again, a good reason not to call. All right. Very good reason. They pay a lower coupon to the investor, so they continue at 3.07. Now, there were two companies that resets to a higher coupon and they continue. They chose to continue the bond and not to call. Lipo Malls 6.6 to 8%. ESR REIT from 4.6 to 6.62. So even though the coupon was higher, they chose to continue. All right. Frankly, these two companies, we should avoid them in buying bonds, in buying REITs. That's my opinion anyway. For those who know me, you guys have asked me about ESR REIT. I don't even touch ESR REIT. All right. That is my view. That's my view of that management. All right. All right. Now we look at perps that were caught in 2022. Now, these perps, they have not just a reset in 2022, they have a step up. So they were called Olam, Singpost, Fraser Prop. They called on their reset date and the reset date has a step up. So they do not want to pay a higher coupon with a step up, so they call back. So it's good to look for those bonds with a step up, of course, but there were very few of them. Now, bonds with a reset, and they were called Wing Tai. You see, Wing Tai 4.08. This 4.08 has a call date and a reset date, and they call. All right. Now, the earlier Wing Tai, 4.35% here. You see the 4.35. Higher coupon, they continue at 4.35. They chose to continue because there was no reset. Once they have a reset, Wing Tai call. Even though the coupon is low, they don't want to continue. All right, so you understand now. Need to have a reset date. Next. Now, there were three companies. No reset, but they called. Maple Tree Treasury 4.5% perp. ARA asset 5.2% perp. DBS 3.8% 2028. This is a straight bond with a maturity there, but they chose to call back last year. All right. So DBS called back a bond last year when there's no reset at all. Now, what about 2023? Will perps be called? Now, thus far, in month of January, these are the 4 companies that were called, all right? ARA Logos, Gogoland, Phaser Properties, UBS. So far this month, every single perp was called. None of them wasn't called at all. All right. So Phaser Property is quite interesting. Even though there is the reset is 2028, they chose to call now. There was no reset, but they chose to call. All right. Now take a look at this price chart of a UBS. Okay, UBS was called, you see. Now, UBS for 2022, they traded below 100. Below 100, even as low as 85. But somewhere in December, the news came, the company news say that, hey, they want to call, the price shot back up to 100. So it was about 94. And once the news came out, shot back up to 100. All right. This is the typical pattern of a perp right now in this market. You can buy a lot of perps that's below 100 because the market is not sure whether they'll be called or not. Now, this table is a table that is the perps with the first call date in 2023. That means coming up this year, I'm simply telling you on this slide that there are 4 perpetual bonds with call dates. Okay, with call dates. And right now, I have only like 5 more minutes, all right? So I cannot cover too long. I will just tell you that without going into details why, if I were to bet with you now, I will bet that all 4 will be called, all right? Yeah. Okay, so, but this is not the slide to show you the opportunity yet. I'm just saying that this year's perps, these 4 of them, likely they will call, all right? Now, I put interesting to denote that it's interesting for me to consider buying, all right? So these are the 4 bonds I'm considering for myself, all right? They are the REITs of perps. Later, I'll show you more bonds that is not REIT perps, but they are normal corporate company perps, all right? These are REIT bond perps, okay? Maple Tree PAC is Pan Asia Commercial Trust, 3.5%, all right? Escort 3.07, Star Hill 3.85, Paragon 4.1. Now, the coupon you will first realize is very low. They are low. And here, because it's low, interest rates has gone up, so the price fell. So these are the prices right now of these bonds. So if today I buy these bonds at these prices, which is after commission, this price is after commission. If I buy the prices of this bond, I will get this return. This YTC means yield to call, all right? Yield to call. So in short, if I buy this bond at this price, at the 90.3, and if it is called on 30th June 2025, my yield per year is not 3.07, but 7.54. Okay, 7.54. To me, 7.54 return on an escort perp is pretty decent. Pretty decent. Now, what is the risk? What if they don't call? The key risk of a perp, like a good quality perp, is what if they don't call? All right. So there is a reset. The reset is the 5-year SOR plus 2.5%. So if today escort, if today is a call date, if today is a call date and escort choose to continue the bond, it will be 3.1 plus 2.5 to 5.6. So the coupon of 3.07 will become 5.6% return. A new coupon, 5.6% new coupon. So if today is a call date, it continues today at 5.6%. All right. But today is not today is not the call date. The call date is 30th of June. So on 30th of June, we have to look at what is the prevailing 5-year SOR rate. At this number, to 2.5%, you will arrive at the reset date. All right. And I think these are the bonds I selected for myself. I think is very decent returns for a perpetual bond. All right. If you tell me like 2 years ago, I can get a escort perp at a 7% return or even a 5% return, it is excellent. All right. It's excellent. What are the other opportunities? All right. I'll show you 4 more here. All right. Maybe I've only time to focus on these 2, the first 2, OCBC perp and HSBC perp. Now, these 2 perps have call dates in 2023. This year, they are about to call. So if you buy it at close to par, near 100, all right, for OCBC, you get a 4% return, about 4%. For HSBC, you buy about 100, you get about a 5% return. That is assuming it is called back. You get 4 to 5% return. Now, what if it's not called? But okay, to me, I think they will be called. I'm quite sure they'll be called, all right? But assuming it's not called. Assuming it's not called, you know what's the reset of today? Not in August 2023, but January 2023. If the reset is today, your OCBC 4% will become a 4.911%. Your HSBC 5% will become a 5.765%. All right. So this is precisely, so the reset right now is currently, because of the high interest rate, it will rise even higher than the current coupon. I think these 2 bonds are quite a good pricing right now. All right. All right. So this is my plan for 2023. This is my second last slide. All right. The plan is this: to cautiously increase investment to REITs and perps. All right. Cautiously increase, not show hand, not sell the house, but cautiously increase to buy at a relatively cheap price now. I want to trade stocks that benefit from China reopening. All right. And at the same time, throughout the year, I have to look out for signs of recession and signs of inflation reversal. Okay. And for this year, I favor China, Hong Kong, Singapore stocks compared to US stocks. And of course, I plan to stay invested. And ladies and gentlemen, please help me by joining my mailing list at wealthlands.com or my Telegram channel. Thank you very much. I'll be putting up my slides onto my wealthlions.com. All right. Thank you, Richard.
Okay,
do you have the
thank you.
questions?
Yes. Okay. Thanks, Ian. Thanks for a quick summary of perps. I think you have flashed quite a few interesting opportunities. And yes, perps and bonds of REITs are one of your favorites. Right? Because and maybe one of the questions that to some of the audience who are not too familiar with bonds and perps, maybe you can I'll just ask you a few questions first to set the stage before I bring on the questions from the audience. And the first question would be, what is the difference between bonds and perps? A quick answer to that.
Bonds typically have fixed maturity. That means with a date that the company must return you the money. If they don't return you the money, they have to file for bankruptcy. All right. For perps, it's an option. It is a bond, but yet it's an option to return you the money. They have an option. I can choose not to return you the money, but the coupon may be reset to a higher coupon or a lower coupon. And it's at the option of the issuer, the company, not at the option of the investor, at the option of the issuer.
I see.
And so because of that, perps, if a company were to issue perps, they have to attract investors with a higher coupon than straight bonds. So if they are issuing a bond at 3%, they have to issue a perp at 4% at least 1% more to attract investors to invest in the perp.
I see. So bonds is like fixed deposit lah, with a fixed
Yes. Yeah.
maturity date that the investor will get back their principal plus interest, right? So for perps, it's like an open-ended fixed D. I know there's no such thing, but it's like a
Open-ended, or you can sell your bond. The only way to exit on your own is to sell it in the secondary market. All right.
so
Yeah.
even bond or perps both can be sold
So
in the
yeah,
secondary market.
correct.
But the definite but by the design, bonds is like have a fixed maturity date like a fixed D, right? And then for perps, there isn't such a fixed maturity date. So that's
Correct.
why instead of a fixed maturity date for perps, it is called the call date. Am I correct?
Correct. Instead of maturity date, they call it a call date. All right. The meaning is almost the same but slightly different. Call meaning is an option of the issuer to call.
Right.
Yeah.
So, for those of you who have asked the question about what is call, what is step up, and what is perp, I hope through my Q&A with Ian, we can give some enlightenment to that. So that's on bonds and perps and the call date. So the call date, if they don't call, if the issuer don't call, issuer means the bond, the one who sell the bond or the perps. If they don't call at the call date, usually there's a condition. They give a certain benefit to the investor, correct? And that is called the step up.
Step up. Correct.
So
Yeah.
step up is
Yeah.
so you have the slide on the screen. The step up you show here, can you maybe show where is the step up?
Wait.
The table there, just now the table.
Step up was there a step up? Wait.
3.1 plus.
Okay, that's not a step. Later. Wait. Hold on. Hold on. Okay. This is the slide that I want to show you. There is no step up. This is a reset. It is 3.1 plus. This is the technical word I didn't cover today. It is the initial spread. All right. But together it is called a reset. A reset. All
Okay.
right.
So
So
if they
this is a
don't call,
reset plus an initial spread, not a step up yet. So these four bonds don't have a step up. There are bonds with step up. So if step up means plus another 1%, typically 3.1 plus 2.5 plus 1. All right.
Okay.
Yeah.
So on a call date, they will reset to this rate. Usually it's the 5-year SAW plus a certain percent, right? So in this case, this table here, you have the current 5-year SAW is 3.1%, and then the plus the okay, Ian, I lost you just now. Okay, yeah, back. Okay, so
The initial spread
mm,
is different for different companies or
mhm,
different bonds. All right. So the first number is the 5-year SAW. Second number is the initial spread. The step up is not here for these four bonds. There
okay,
isn't any step up, but they together it makes the reset to the prevailing interest. So it's the prevailing interest rate plus the initial spread gives you the reset rate.
right. So no step up in these four
Four. Yeah.
examples you see here. All right. So those with step up will just add another. We'll get more lah.
Yes. Correct.
Okay, got it. So I hope this answers the question for those of you who is asking about what is the perp, what is the reset, and what is step up. Okay, so if you want to know more details because you're attracted by the yield or what they call coupon rate in the case of bonds and perps, please reach out to Ian directly. Okay,
Maybe
so
I
he
just
can
want
help
to
you.
add, you see, this is the returns, all right? This column here is the return that you see the mouse, okay? You compare this return versus a REIT. You compare to buying Escort, compare to buying Maple Tree, Pan Asia Commercial Trust, Star Hill, Paragon REIT, and compare the returns and see whether you like it or not. When you buy a REIT, there is also a capital gain or loss perspective. All right. So, for example, you buy Paragon REIT is probably about 5% now. 5% dividend yield at the current price. You get 5% return at the current price, but you participate in the capital gain if it goes up, or if there's a recession, it will go down in price. You will lose money. All right. Whereas if you buy Paragon REIT, in this example, you get more or less an assured 6% with little upside or downside.
Right. Okay, good. Ken, thank you, Ian. Let me see what questions we have from the audience. Okay, Connie is asking, what is the minimum sum to invest in these bonds and perps?
Okay, good question. The size of these bonds is 250,000. All right, so the minimum lot size is 250,000. Okay, you do not need to be a high net worth. Anyone can buy it. But the minimum lot size is 250. Okay, for so I encourage you, if you have 250,000, you can buy one lot. All right. Typically, a person with $1 million, all right, spare, they will buy 4 lots, and they earn typically about 5% coupon. So in a 5% coupon, they will get about 5% or 250,000. Sorry, sorry, 5% of 1 million. It will be 5% of 1 million. It will be 50,000 in a year. Sorry, is it 50,000? Yeah.
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 Yes.
Correct. Yeah. 50,000 in a year. So if you invest 1 million, you get 50,000 a year, typically. Now, there is also this aspect of leveraging. So for those who want to leverage, meaning, for example, if you don't have 250,000, you can just fund 100,000 and you borrow 200. Okay, you put in 100,000 and you borrow 150,000. So 100 plus a borrowed 200 plus a borrowed 150,000 equals 250,000. All right. So Maybank Securities also provide borrowing. They will lend you money. So the current rate that you will lend money is 3.8%. All right. So for example, this yield here is 7.4%. You are borrowing, not all, but part of the money you borrow at 3.8%. So it still make a decent case of leveraging in this high interest rate environment. Okay, I will cover this more in detail in leverage bonds, all right, or I call supercharged bonds. Connie, you watch out for my webinar or seminar coming up.
Okay, thank you, Ian. So I think that's all the time we have for the Q&A with Ian. So if you have more questions specific to bonds or what he has covered, please feel free to reach out to Ian at his website at wealthlions.com. Okay, so and he also planned to have another webinar in about 2 weeks' time. And once that's the dates and time is confirmed, he will be sending out the detail in his Telegram channel. So please join his Telegram channel as well at wealthlions.com. Wealth Lions. So you search for Wealth Lions in the Telegram and you can join it so that you can be kept posted. Okay. Thank you, Ian.
Thank you, everyone.
Thank you.
Happy New Year.
Yes, Happy New Year. So James, I can see you. So maybe you would like to take over the screen and also unmute yourself.
Okay, can you hear me now?
Yes, can hear you.
Okay, let me try to share screen again.
Can, no
Okay.
problem. Otherwise, I have your slides on my screen so I can be
Okay,
your clicker.
I have shared my screen. Can you see it?
Okay, let's wait for 10
Everyone
seconds.
can talk already. I finished.
Ian, you need to mute yourself.
Sorry.
No worries, no worries.
Yeah, I already share screen.
Okay, let's wait for 10 more seconds and see whether it turns up, just in case.
All right. Doesn't work?
Yep, I think it's not showing. Yeah, no problem.
Okay.
Let me share it on your behalf then.
Okay. Thanks.
Okay,
Thanks,
no
Richard.
problem. Share. Okay, let me see if it appears. Let's also wait for 10 seconds.
Or is it the Google Slides that's having issue?
Cannot be leh.
It's not showing. It's not
Yeah, it's not showing also, huh?
showing.
Could be the software also.
Yeah. Okay. So
Let's
do you want me to?
let's wait for another 10 seconds and see.
Loading error. I see a loading error.
Screen sharing. Oh, interesting. Let me try again. Share screen.
Can I share it as a Microsoft PowerPoint?
If it doesn't go through the web, then it wouldn't work for
Go through.
PowerPoint as well. Yeah, because this is a browser-based app.
Oh, that's weird.
Try again. Sorry, guys. Let me try again. Technology can fail us sometimes.
It's weird that we succeeded just now.
I know. Even during our testing before the session.
No, I think it's taking too long.
Yeah, very weird. Kenny, would you like to try to see if you can share your screen?
Can you hear me?
Yes, I can hear you.
Okay, I'll try.
Maybe you try and share. If you can, then we'll try again later with James. Sorry, James. Let's see whose slide can load up.
Can you see?
Let's wait for a while.
I can see my slide. Are you able to see?
Not yet.
Not yet.
Hmm.
I think I have the same issue as Kenny.
Actually, I can see on the browser, no? I can see clearly my screen is there.
I know. I understand. It's just that I don't see it as an attendee.
Oh,
Just
you
now when
want
I try to share, also it appears on my screen, but it doesn't get shared into the webinar.
So attendee cannot see.
Oh, I think someone's saying, can we share to Yen? Then she shared it from.
We can try that. But I don't know whether he's still available.
Okay, I do
Ian?
another way. I share PowerPoint.
Okay, 你试试看. Ian?
Okay, I also can see when I share PowerPoint.
Let's wait for 10 seconds.
It's still loading.
Yeah.
Now you share your slide also cannot.
Yeah, lor. I share my side also cannot. We wait for a little longer and see if can or not. Worst case scenario, instead of keeping everybody waiting, we will schedule for another date for the session.
Last
we'll
year
give it-
need to wait for a while.
Yeah,
Last year
lor.
this technical
So we will try again. We will give it a little bit more time. And if really cannot, then we will have to, trouble you guys to attend another time. Or we will do a recording and then we will post it. Yeah, so either ways, we will find a way to share the insights that our speakers have prepared with you.
Error.
Still cannot. Screen loading error. I try again. Kenny, I try again.
I try again.
我 try.
Okay, we'll try.
我 try. So I say stop sharing.
Do you have any function to upload inside this webinar?
Nope.
No.
This is the
Okay.
feature to use.
Oh,
This is the feature to use. Yeah. So 如果不可以的话 we will adjourn and then we will. I think the easier way will be to do a recording
okay.
and then I'll send out to all the attendees.
That's not okay.
Yeah, not loading, huh?
Yeah.
Yeah.
How
So
come Ian can?
yeah lor. So let me see. Okay, we will give it a last shot. Let me see if Ian is available. Hang on.
Meanwhile, let me try to share?
James, you try.
Yeah. Cannot close the tab. Okay. And see?
Nope.
No. Yeah,
Loading.
it's appearing on my screen, but
Yeah, same thing.
yeah, same. To do the recording.
Okay, I think let's make a decision that we will do a recording and then we'll send out to the attendees so that we don't keep them waiting. So sorry, speakers Kenny and James, about this. Despite us doing all the practice, is the technology failed us at the live live show.
I think we can continue to wait. Both
Mhm.
me and James.
Mhm.
If it's we may need to wait a little bit longer to load, then we record lah. Anyway, whoever want to
later
stay,
we try.
wait lah, can wait lah.
哎，我看到
Hello.
我看到了
Okay,
Oh,
that's right.
really?
Yeah.
right?
That's
Okay.
last year. I need to wait for a while.
Okay, let me see. This is me or this is James? James, are you the one who tried sharing the screen just now?
Yeah, yeah.
Okay, now you try and go to the slideshow mode.
Okay.
I can see your cursor. Yes. Okay. All right.
Okay. So sorry for waiting.
No,
Yeah.
thank you,
I
James.
think
Okay,
maybe
thank you guys.
I have too many pictures.
No lah, no worries. Okay, James, all
Okay.
yours now.
Let's get
Thank you.
started. Okay, everyone, happy Chinese New Year. Apologies for all the tech disruptions. And also, I just recovered from a sore throat, so I have to apologize in advance in case you hear my voice like a bit coarse and all that. Okay, after the Chinese New Year celebration, so having sore throat. Okay, so I think I'm pretty new to the OTCS community lah. So maybe I just share a bit about myself. So I've written for many different websites like foo.sg, which is now smartinvestor.com.sg, Finance Investor One, and all that. So I am also a ACLP certified. That means I can teach skills future courses as well as a SGX Academy speaker. I also founded this Small Cap Asia website, and then recently I came out with this new YouTube channel. All right, so this YouTube channel will be more covering on both Singapore as well as US stocks. So right now it's just started for a few months. I think right now it's 300 subscribers. So appreciate if you can help me to achieve my goal of 1,000 subscribers at this bit.ly/investcard link. Okay, so once I hit the 1K subscribers, then I'll be more confident, and then maybe I'll make it more frequent and things like that. Okay, so without further ado, today's agenda, okay, we will talk about macroeconomy. So I'm talking about US stocks and economy today. All right, I will talk about the market sectors as well as give you 3 US case studies. Okay, so the first one will be the macroeconomy. So what we have now, right? Every time you look at the news, the US news is all layoffs. Google laying off, Netflix laying off, Amazon laying off. And you can see from the chart over here, okay, since January 2022, okay, the employees laid off and the companies with layoffs have been increasing sharply to the recent January 2023. So the trend has been growing, okay? And sorry for the format because by right this one is supposed to be going onto the Google slides. All right, so there's an acceleration of layoffs since January 2022. Okay, and if you were to check out this website called layoffs.fyi, okay, they focus the layoffs on all the tech companies, Google, Microsoft, Cisco, Uber, and all that. All right, and what we can derive from here is that most of the layoffs, right, are mostly in tech. So what happens is that over the 2-3 years, right, during the pandemic, all these tech companies, they wanted to gain market share, they wanted to compete with the other companies, so they decided to hire a lot of people. So they have over hiring, and right now is just trying to trim off this so-called additional layer that they feel that it's not productive. Okay, so you can see that it's mostly in tech companies. And what I read about these layoffs is that because of all these the technical people that they have, they all have a very good skill sets, and they are likely to find new jobs more quickly as compared to like blue collar and all that, because tech is definitely in demand. You go out of Cisco, maybe you can jump to another ST engineering, cybersecurity, something like that. All right, so it is not as bad as it sounds with all these layoffs, because it is happening in tech, and all these tech savvy engineers, software engineers and all that are likely to find new jobs. So the second thing about the US economy is that high inflation has caused high interest rates. So the government wants to step in and control the high inflation. And you can see that the interest rate has gone up to 4.5%, and the Fed projects it to increase to 5.25% at the end of this year. So not so sharp increase from last year, but still, there's a bit more of hard increases. The scary part is this is what everyone is talking about, this inverted yield curve. If you look at this picture, right, the normal yield curve, the blue color line, is going up, and then as the number of maturity of years, all right, the yield starts to come down. But in the inverted case, right, you can see that it's actually high at the start and then going down at the end. So what does this mean? All right, let me share with you the cause and effect of this yield curve inversion. What does it mean in layman terms? Okay, yield inversion is that, to put it simply, is the 10-year bond, all right, interest rates is actually lower than the 3-year interest rates. And this happens when investors are nervous about the future and expect short-term rates to fall. So if you think about it, common sense, right? You invest in something for 10 years, you want higher returns, right? But in fact, you are getting lower returns than the 3-year. You are getting lower returns in the 10 years compared to the 3 years. So when this happens, when so many investors think rates are going to fall, all right, the 3-year rates are going to fall. So they crop into the longer dated 10-year bonds to lock in the so-called high rate. and this makes it a U inversion. Okay, and why is it so important, right? It's because of the effect that it has on a lot of people. Okay, so this guy, all right, is Harvey. Okay, he's the godfather of this inverted U curve. Okay, he created this U curve effect. And since World War II, he predicted that every U curve inversion has been followed by a recession in the following 6 to 18 months. And recession is usually, stock market crash. All right. You can see from here, all right, how he has performed, okay, since 1965. Whenever there is a negative, that means the negative spread, they're going into the red color zone. All right, it is followed by the recession within the 1 to 2 years. So if I were to, okay, maybe take a pen. So let's say you look at this. All right, this is the recession. Okay, you look at this. The gray color is the recession. Okay, you look at this. 2009, right? And then this is the recession. So within 1 to 2 years, there will be a recession. Okay, but what is the contrary case here for this year itself? Okay, this is the quote from the godfather, right, himself. Right, he mentioned that my U curve indicator has gone code red and is 8 for 8 in forecasting recessions since 1968. However, he believes that it is flashing a false signal now. So what does it mean? Okay. So he explains it over here. So the first reason is that because of the popularity of this tool, this inverted U curve, it impacts the behavior and induces the companies and the consumers to take risk mitigating actions, such as increasing savings and avoiding major investments, which bode well for the economy. So the second reason is that, is what I said previously, all the large job cuts are concentrated in the tech sector. So my take after hearing all this, right, is that, okay, while I feel that, okay, the recent recession will be averted, because when everyone is talking about recession, right, chances are, the recession will come in. Okay, but it will be a long winter of slow growth, because when we think about it, we have high interest rates and it's like unlikely to come down anytime soon. They won't say that, oh, this year 4%, next year 5%, then maybe I'll go down to 0%. Very, very unlikely to happen. All right. So they are forecasting that the recession will come. Okay. And they are willing to do that to control the high inflation. So what I feel, okay, personally, is that there will be slow US growth, okay, and it will likely persist for at least 1 to 2 years time. So let's talk about the market sectors. All right, so I don't have a crystal ball to predict the whatever market sectors will do well. So I turn to this image over here, and this is a image of the market cycle. You have let me see, okay. So over here you have the market top, over here you have the market bottom, and all these are the sectors. Okay, so over here we can see that, okay, the late expansion part, right, energy sectors is performing. So oil and gas stocks like Chevron, Occidental Petroleum, they are booming. All right, and then afterwards you have consumer staples and utility stocks performing. So you think about it, consumer staples like maybe P&G, Colgate, Pepsi Cola. Okay, Pepsi Cola maybe not. Yeah, utilities. You think about it, Sembcorp Industries, Keppel Corp. When they focus on the utilities, because of the sharp rise in the energy, okay, actually it benefit all the money go into them. All right. So this is, if you are saying that these two sectors are performing right, so we are already experiencing an early contraction. Okay, and when you think about it, okay, when you say banks, okay, financial banks like DBS, OCBC, right now they're going up, right? Bonds going up, right? Financials going up, right? So are we close to the market bottom? Okay. So this is something that, okay, you can analyze yourself, lah, right? So I just give you this image to give you this image. Okay, but what is the three sectors that I will cover today for my three US case studies? Is the financials, consumer, cyclicals, what we call like maybe luxury goods, travel, cars and all that. All these are consumer cyclicals. It means usually, people will go travel, buy car, right? And then you have technology. So technology is weird that it's over here, but I will also share with you all in the case study. So now let us dive into the three US case studies. Okay, for the first stock is this Charles Schwab. All right, if you haven't heard of it before, it is based predominantly in the US. They have acquired, all right, TD Ameritrade in Singapore. I think 1 to 2 years ago. Okay, and their business model have evolved over the years. So in the past, they have been focusing a lot on maybe trading fees, and all that. But recently, they shifted to AUA. So I think similar to that of the iFast Corporation. So what they earn, right, is the net interest income based on the cash that's inside their customers' accounts. So let's say, for example, I put in 10,000, I only use 5,000 to trade. So the other 5,000, I park it with Charles Schwab, and they are going to earn the very minor 1% interest. But if you think about it, if you have trillions of dollars, billions of dollars, that 1-2% is very significant. Okay, and although this kind of stock brokerage of fintech companies is nothing special, their competitive advantage is that they are focused a lot on operational efficiency. So much so that, right, they are the first to offer zero cost commissions in the US. All right, and with that, right, they are able to offer low prices and higher value to customers. So it's like a flywheel effect. And a testament of their track record, right, is that the assets held at the company have grown from 1 trillion in 2005 to 7 trillion in 2022. So $7 trillion. That is like an amount that we cannot imagine, right? Okay. And so based on their latest, the financial report, their net interest income is actually contributing 50% to the total revenue. So if you think about it, the rate hikes will have a direct boost to their revenue. And this is also taken from their presentation slides. All right. So despite they say that the rate hikes might be easing down. Okay. So if you look at it, right, the rate hikes go up 4.75, and they predict that it will come down to 4%. But their net interest income currently stands at 1.97%. So they anticipate it will expand beyond 3%, despite all the easing going forward. So if you think about it, 2% to 3% is 1%. And if you have 7 trillion, 1%, that's very significant. The second stock I want to talk about is Airbnb. So Airbnb belongs to cyclical, I would say, because we talk about traveling, right? And if you were to visit the website, you can see that Airbnb don't just offer hotel, kayak, Travago, Pagoda, and all that. So they offer different kinds of stays, right? Ranging from like you have this kind of like what, oh my god, right? This is oh my god, to what Hankoks lah in Korea, Rokkans in Japan, boats, even castles. So you can say that they have a very unique niche that other hotel players cannot infringe on. And the other thing I like about Airbnb is their focus on experiences. Experiences. So previously, during the pandemic, Airbnb is stuck there. Then they think that, oh, there's nothing they can do. No, sorry. A lot of accommodation players, they think that, oh, there's nothing they can do. They just wait out the process. But Airbnb is different because they are a platform. They can come up with new things. So they came out with these experiences, and there are a lot of people already, using them. Like this, plan the new perfect New York vacation, 157 reviews already, 5-star review. Yeah, so this is something that is another, they kind of help them to build the competitive edge. Okay, let's focus on the investment merits of Airbnb. So post-COVID, right, their free cash flow margin trailing 12 months actually stands at 40%. So for every $1 they earn, okay, they make 40 cents of free cash flow. That's a lot if you think about it. So 1 billion is 400 million free cash flow. All right. And in the past, they have a lot of debt, okay, but they have been trying to decrease the debt because in the past it's COVID, so it's understandable. But they have been trying to keep it manageable right now. And if you were to think about it, people still want to go on vacation, all right, but they prefer a cheaper option compared to hotels. Okay, I think an example is my neighbor. All right, my neighbor actually went to, I think, can't remember, Korea or what. So they actually stay Airbnb also. So they didn't go for, hotel stay at Agoda or Booking.com. Right, because it's cheaper. And nowadays, if you think about it, the younger generations, right, are going more towards Airbnb. And if the younger generation is at Airbnb, slowly, throughout the years, they'll be sticking to that. And there will be the what you call it, the switching economic mode. Yeah. Okay. And a lot of people, right, in face of a potential recession, they decided to, maybe I rent out my house lah. I offer people scans or rent out things. So it's not legal in Singapore, but there are a lot of countries out there, people are willing to do hosting to earn extra income during this recessionary period. So with that, yeah, the stock number 2 is Airbnb. All right. Oh, sorry. So one more slide, and maybe I just want to share also about the recent China post-COVID, right, outbound traveling. So they say that the crown jewel has always been the China outbound. China outbound means China people traveling out from China. Okay, and they say that the take rate was higher because the inventory is more unique. Less competition, the average daily rate is a lot higher. So they have an office in China, but they are not meant for people going to China. All right. When people go to China, maybe you want safety, you want to stay at a hotel. But it's more for those rich Chinese. They want to travel out, maybe to Singapore, to Australia, that kind of region. And then they look for Airbnb for unique experiences. All right. Okay, the third stop. Before that, let me drink a sip of water. Okay, the third stop I have is Zoom video. All right, so a show of hands, who are still using Zoom at the moment? Again, I can type it inside the chat box to let me know. Okay, meanwhile, I just continue because we are out of time. All right, so personally for myself, right, I use Zoom during work. Okay, I also use Zoom when I talk to my kids' parent. During the parents teacher conference, I also use Zoom to liaise with the teachers. So if you think about it, Zoom is like has become a verb or a noun for video conferencing, same like Google. You don't know this, go and Google lah. So it has become such a strong brand recall. All right. And what's interesting is that their share price has plunged 86% since the peak at October 2020. And right now, if I'm not wrong, their P ratio is around 15 times only. Okay. But other than that, a lot of people is saying that, oh, Zoom video is going to face fierce competition from Microsoft Teams and Cisco WebEx. So what is it, the real case, right? Let's look at their numbers. Taking their latest financial results, they still have a lot of cash flow, 25% of the market cap in cash, all right, and generating ample free cash flow. So if you think about it, wow, my whole market cap, the stock price times number of shares, 25% is in cash. That's so much. They can easily just buy over anything, right? And they are focusing on this Zoom One. So Zoom One is a suite of the different Zoom products. Okay, is what they are focusing on right now, and it is able to boost their total addressable market, okay, TAM, from 62 billion to 86 billion. So if you think about it, they are fighting against those existing companies like Five9, those call center, whereby Zoom can reach out to the company and say, I will do everything for you. You connect your Zoom, video conferencing, your phone call, everything, mail, combined together as one whole package. Okay, and they are largely focused on the growth in the enterprise segment. So they know that as consumers, we won't pay for Zoom. We can just use the 40-minute, time limit. But for enterprise, if you think about it, every month is just maybe $10 over, at most is $20 per person. They wouldn't really scream on that kind of savings, as long as it helps to, maybe also reinforce the work from home. Maybe 2 days you're working from home, you can use Zoom to liaise and things like that. Okay, so this enterprise segment will allow Zoom to do cross plus upselling. Okay, so with that, okay, I've shared the 3 US stocks. All right, I just want to wrap up quickly. Conclusion, there will be a slow US economy in the future, maybe 1 to 2 years time, due to the high interest rates, as well as how everything is still very uncertain. Sectors such as financials, okay, and consumer cyclicals likely to benefit from what we see on the image over there, okay. And we have covered 3 stocks: Charles Schwab, okay, Airbnb, as well as Zoom Video Communications. Okay, so if you want more stock ideas like that, okay, do remember to subscribe to my YouTube channel at bit.ly/investkaki. Also share the link in the chat lah. Okay. Okay, so these are some of the videos I've done in the past. Okay, thank you very much. Now I'll hand over to Richard.
Okay, thanks, James. Thanks for your sharing. And in view of, so if you have any questions for James, please feel free to type into the chat box. And meanwhile, Kenny, you can start sharing your screen so that we can see if we can iron out the weighting of the slides, in case there's another technology issue there. So for all the attendees, if you have questions for James, please feel free to type into the chat box. James is joining us for the first time with our OTCS webinar, and he is a writer who analyzes stocks and write for Yahoo Finance and also the Motley Fool. So he's very experienced in analyzing stocks. So please tap his brains while he's here. Yes, James. While you have shared your that 3 stock picks for us, so do you you're sharing them from the angle of fundamental or from the technical. Do you use TA?
I don't really use TA. I use FA more.
So
Yeah.
you are just now when you selected the three stocks is from the angle of FA. Am I correct?
Yeah.
Right.
FA.
Then and you do not use TA, is it?
Mm.
To pick your, then how do you decide when to buy or what price to buy?
Okay, so I use very simple things like the the rule of 40 back then, when we talk about CR stocks. And then I also use things like the DCF, discounted cash flow. So I think nowadays I'm focusing mostly on cash flow positive, free cash flow positive companies, so that I am more certain of their outlook. So as long as you have a quality company generating free cash flow, and I'm able to, forecast what is the growth in the free cash flow, I'm able to do something like, DCF, and then I usually do not um, pinpoint the exact price. So as long as I feel, okay, maybe for example, Zoom video, can I expect that their free cash flow to be growing or to be at least constant in the next 10 years or so? If can, then maybe I discount back. If it's a price that I like, if there's a margin of safety, then I will be buying the stock. Yep.
I see, I see. So what kind of margin of safety are you looking for, and how do you measure that? Let's say for the
I
case of Zoom or Airbnb or Child Swap,
Yep.
is it 30%? That means you arrive at a valuation, then you take a percentage off, and then you wait at
Okay.
that price or what?
Yeah, very good question. So I think right for US stocks, there is more of quality growth rather than margin of safety. So if you think of margin of safety, right, like what Warren Buffett always share, he focus on more of all those old economy stocks like the one I share, Chevron, Occidental Petroleum, Apple, that kind of thing. So usually these kind of companies, right? Okay, so the companies that I focus on, right, like Airbnb and Zoom Video, they don't necessarily have margin of safety, but I usually look at them to see whether they can grow in the next, it's more like a quality growth kind of a thing. So I don't really harp on that kind of a valuation. So anyway, valuation is both an art and a science, like we know. So during this recession, right, everyone is running from tech stocks, and I would be more inclined to look at them. So this is the way, I mean, the basic way of how I look at it. Yeah.
I see, I see. Then do you consider looking at dividend stocks from US?
Okay, so I think that's also a very good question. Dividend stocks, right? Usually, I would say focus on Singapore because US has this withholding tax, and it doesn't make sense like you earn the dividends. Okay, and US companies, they don't usually give a lot of dividends in the first place. And then let's say you get a company that pays maybe 3-4%, and then you still have to pay withholding tax. If I'm not wrong, it's 30%. So net, I think you get only 1-2% out of it. So I think it doesn't make sense. If you want, you know, what do you call that? Dividends or passive income, right? I think you should go for Ian or Kenny lah. They focus on REITs and bonds, right? That's more. I mean, that's what I would do lah for going for dividends.
Right, right, right.
Yeah.
Okay, now I'm done with my questions, so I will pick a few questions that are asking you from the audience. And there's another James in the audience,
Yeah.
and he's asking, what do you think of PayPal?
Yeah. Okay. PayPal is a very good company, quality sense lah. Because I usually try to keep it simple lah. If I think of it, is are other businesses still using PayPal? Yes. Okay. Is there still room for growth for PayPal? I think yes, because a lot of people are still, maybe still not going to the online payment space yet. So they have a lot of competition, of course. Like all those crypto lah. Last time they talk about, wow, crypto are going to take over Visa, Mastercard, PayPal, but now all gone already. So I think PayPal will still have some room to grow lah in the future. Yep.
Right. Another question comes from Patrick. And Patrick although he's still using Zoom, but he felt that Zoom's usage have reduced a lot last year because of the other platforms that came in to compete. So he's wondering why you still pick Zoom when the competition is so so hot there.
I think that's also a very good question. I think a lot of people say, okay, now got Google Meet, right? It's free. Got some other video conferencing tool all free, right? But if you think about it, there's also Google Sheet, Google Docs in the past. Why still a lot of people? I mean, why are there still a lot of people using Microsoft Office? It's because it has been stuck since the past. And then when you have the market leading position, right, it's very hard to bring down the market leader. So if you think about it, Zoom has so-called been segmented as the leader in video conferencing during the 1-2 years. And then if you think about it, like what I shared in the slides, right, Zoom has become a verb or noun already. If you want anything, I'm going to Zoom. Later I meet you through Zoom. So even though for us consumers, we've been using less of it, but the enterprise segment, which they are focusing on, is still showing considerable growth of at least double digits, if I'm not wrong. So, all this, like what I said, all the companies, right, they wouldn't mind spending, less than $100 for a Zoom where you can benefit for your employees to work from home, as well as to reach out to third parties outside and maybe potential business partners that you want to communicate via video conferencing and all that kind of thing. So they are targeting the enterprise segment, and there will be still considerable growth in that segment. Yep.
I see. Okay, great. Thank you, James. Thank you for your sharing with us and the three stocks that you have shared with us and why you think they are good. And again, to all attendees, this is not financial advice. It's just James sharing his opinion. If you get some ideas from what you hear from the webinar, please do your own due diligence. Seek a professional advice if you need before you make your investment, because none of the speakers nor OTCS or the sponsors are liable for your profits nor your losses. And James, that will be the last question. And
Okay.
you mentioned that you have a YouTube channel, right? So for anyone, James has already shared the link in the chat box. So if you can support him by clicking on the link, you can please subscribe to his YouTube channel. He's going to be an up and coming financial YouTuber from Singapore.
Thank you.
Yeah,
I will touch on Zoom, PayPal, and Tesla. Okay.
he will touch on that in the coming days. So do subscribe. If you want to search for his channel in YouTube, just search for Invest Kaki without an S, Invest Kaki in YouTube, and you can see his handsome face there. Okay, so thanks a lot, James. Thank you for sharing. And now I will hand over. Thank you, and I'll hand over the stage to Kenny. Kenny, let's give Kenny a full 30 minutes plus 10 minutes of Q&A until about maybe 10 o'clock. So if any one of you need to plan your time ahead, it will be, let's give Kenny the full time that we wanted to give every speaker. All right. So Kenny, your slides is on the screen. Let's go.
Can you hear me?
Yes, I can see and hear you clearly.
Right. If anyone still any one of you still stay until the end of the session, actually you all should give a round of applause to Richard. I think he'll be very stressful as an organizer to the technical issue. I can feel his stress also. All right.
Yeah, thank you, Kenny.
Okay, so I will start with the Singapore REIT market outlook for this year. All right, so there's some disclaimer first. The presentation is for education purpose, and I will be quoting a few examples. Is a specific REIT in my sharing, and not a buy or sell recommendation. Please do your due diligence and speak to your financial advisor. By the way, I'm the licensed financial advisor, although some of the things that I present here, you can use it for your own investment, but due to each individual special situation and also your financial status, some of the sharing here may not be useful or applicable to you, just to take note. And also whatever thing, I'm using a lot of example and also past performance to do the case study, and just take note that past performance are not an indication for the future performance. Right, about myself, I'm Kenny Low. I am the certified financial planner and also risk specialist from an independent financial advisor. That's my full-time job. On part-time, I am the S-REIT trainer for SGX. I am conducting the SGX Academy REIT course, which is a 2-day course and also sponsored by IBF. If you're interested, you can go to the SGX Academy to look for those courses. Right. At the same time, I am also the lead trainer to certify the financial advisor, the relationship manager of the banks, and also private banker in terms of the associate REIT investment advisor certification. Every month, I will be go on Money FM 89.3 to give a monthly market update. So if you are the REIT lover or you are the REIT investor, you can tune in to the Money FM 89.3 every month to really listening some of the interview posts by Michelle Martin, and I will basically share my view. My stock investing is my personal financial blog, and I post the money update on the REIT table, the stock chart on my blog itself. So you can go there every month to really understand what's going on in the Singapore REITs. Okay, today's agenda, 3 key main topic. I will go through some of the quick market recap. What has gone what has gone in 2022 and also beginning of the year 2023. And I'll talk about the US interest rate movement. I think that James and also Ian has spoke a lot about it, but I just give you something additional information for you to know, because the interest rate has a very important role and also affecting the Singapore REIT, okay, in large extent. And lastly, I will wrap it out. What are the key things I am watching out in 2023? Although just now Ian also mentioned that 2023 is a good time to really start the accumulation, but I will tell you that what are the risks in the market now, and also what are opportunities, so that you know how to avoid the risk. Don't jump into some danger risks, and at the same time you also can pick up some gem through some of the fundamental analysis. All right, and I will share with you what are the investing strategy you should use in 2023. Okay, market recap. So this is the FTSE ST REIT index. Basically, you give you an overview on what has going on in the Singapore REIT sector as a whole. So if you can see from this chart itself, after the huge sell-off in March 2020, and basically the REIT has V-shaped rebound and moving sideways for the past 27 months. Only last year, October 2022, there are certain drop in the REIT index itself, dropped close to 19%. And after that, since then, we are also more or less having a very strong rebound of close to 18%. So at the start of the year, Singapore REIT has been performing pretty well, and the rebound has been very strong. So the key thing here is, will the REIT index continue to rebound back to the pre-COVID level, or even reach at a higher rate amid on the high interest rate environment? So if you compare to 1 year ago, this is a 1-year chart, right? On the red color represent the STI index, okay? And on the blue line represent the REIT index. And the green line represent the financial sector. Okay, why I'm showing the REIT index and also the financial index is because mainly our STI comprises of the two key main sector, close to 40% from a banking sector, right? The three Singapore banks, and also about 10% or 12% actually is from REIT. So 1 year ago, the financial sector actually is underperformed REIT. You can see that actually REIT performed much better than the STI. At the same time, also perform much better than the bank sector. Only recently, until the change of the interest rate at the Q4 2022, you can start to see that actually there is a huge sell-off in the Singapore REIT. Used to be outperformed and become underperformed, and the financial sector take over. The three banks take over. That's why at the present moment, for the past 3 months, basically Singapore REIT actually underperformed the financial sector and also the STI index. However, at the beginning of 2023 start from here, you can see that actually Singapore REIT doing a very strong catch up. You can look at the rise in the index price itself. The rise is much more sharper than the financial sector and also the STI index. Okay, the key question here is, will this momentum remain? If this momentum remain, it may doing a cash out and also continue the previous excellent performance to be one of the best performance of the sector on the STI index. So this is the key thing that I'm watching in this year. Okay, and S-rate has a strong start in 2023. Year to date basically is about 1 month, all right? None of the REIT, none, zero, they are losing money since beginning of the year. So you can see that actually basically basis across all the sector, but majority and mainly the big market capitalization REIT, for example, Mapletree Logistics, Mapletree Industrial Trust, Ascenders REIT, Capital Land Integrated Commercial Trust, basically they are the leader. That's the reason why our REIT index has a strong rebound, because the REIT index itself basically is market capitalization weighted. They are really driven by all those big cap REIT. Okay, so you can see that actually the rebound is pretty strong. The strongest one year to date, even up to 28%. All right, even the weaker one still have some of the REIT not have a very high return. You can see that easily also can be 5%. All right, so across all the board, the money, the institutional fund basically is coming back to Singapore, and also investor actually is coming back to the REIT sector. Okay, in short. And why we have a strong rebound? And actually, if you are a REIT investor, if you are not really monitoring the market, or you are monitoring the market, you should never miss the last quarter entry opportunity. Why I say last quarter was a very good entry opportunity? If you follow my the Money blog post or Money FM interview, you should not miss it, because I keep repeating for many times. Right, last year at a point, sometime in October and November period, the whole Singapore REIT average price to NAV, price to book value, is about 0.81. And this valuation is as close as during the market crash in March 2020, where we have the whole Singapore lockdown due to COVID. So you can look at it, the PNAV about 0.8, this PNAV is 0.81. But what has changed is, during that time, basically the whole world locked down. The whole world economic has stalled, and basically it affecting all the business. A lot of business go bust, all right? And that's the reason there are a lot of fear in the market that most of the investors, they sold off the position and make the S-REIT become very cheap, 0.8, right? But if you look at the current moment, basically the whole world is reopening. China is reopening. The economy is doing well, and everything is improving. So it does not really make sense that the whole Singapore REIT itself trading at the valuation same as a previous COVID crash. It does not really make sense, because at the end of the day, REIT is the proxy to real estate investment. You are investing in physical property. right? As long as you have a people, you have a traffic, you can rent it out, and the rental continue to increase, it does not make sense that the value will go to zero. So due to this reason, those smart investor has already started to invest during the period, and also I have sent out some buy recommendation to my client during that period for them to start the accumulation, right? And not surprised, and after that, basically the REIT continued to rebound, and at the present moment, he just broke up from a ascending triangle. If you know technical analysis, this is ascending triangle, just broke out, and now at the present moment is on the confirmed uptrend. Right? Whether it can go higher, you just look at the REIT index stock chart itself. This was a pre-COVID level, price to NAV 1.1 time, and at the present moment, it may be around 0.85. My latest price to NAV table will be coming out this weekend. If you really want to know what is the latest average price to NAV value, you can look at my blog post. Okay, again, on my stocksinvesting.com, I post the latest number over there, and you can see that whether Singapore REIT is still attractive or not. All right, basically for me, eventually we'll cash out and back to the pre-COVID level. Minimally, we should be back to this level, because this sell off, they are due to the interest rate hike. Later I will show you why there's a huge sell off here after we consolidated for many months. Okay, this is because of the yield spread. During the peak period, right, just before the sell off of a Singapore REIT, the yield spread actually trading 3.76%, and at the present moment, the rally and it's become very attractive. The yield spread is 4.69%. Okay, so what is the yield spread? Yield spread is the difference between the Singapore REIT dividend yield minus of the 10 years government bond yield, right? At the present moment, although we are seeing the interest rate, US interest rate continue to go higher and higher, even the Singapore T-bill also above around 4%. But if you look at the 10-year risk-free bond rate and bond yield, they are basically is coming down. It's coming down. So the market has already priced in the 10-year bond is coming down. That actually makes the spread wider for S-REIT. Okay, in average, the 10 years average yield spread for Singapore REIT versus the 10 years Singapore government bond yield is about 3.8%. So at the present moment, the yield spread is very attractive. This is another way to look at the whole market valuation to see whether S-REIT is attractive, not attractive or not. So at the present moment, it's attractive. So next, what would be the US interest rate movement moving forward? Based on the latest US Federal Reserve interest rate dot plot, it is expected 2023 will reach the peak at around 5.2%. It's a peak. Then since after that, the interest rate will start to come down. Okay, so when the interest rate coming down, your 10-year bond yield will be coming down, your spread will be even wider. In order to maintain that kind of spread, the whole S-REIT share price has to move up. Right, has to move up so that your dividend you can drop. Okay, if you don't understand technical, never mind, because it's a bit technical. Your share price will go up, dividend drop, so that to maintain a yield spread. So in short, when the interest rate start to pivot and start to turn down, that actually is a catalyst for the Singapore REIT share price. So at the present moment, the market has already pricing in the drop in interest rate, or at least the plateau, and start to coming down. So stock market is always moving ahead what is going to happen 6 to 9 months later. Okay, that is the reason why there's a Singapore rally at the present moment. Whether it's sustainable or not sustainable, we do not know. We'll see what is the reaction after the tomorrow FOMC interest rate announcement. Okay, at the present moment, the US interest rate is at about 4.5%. All right, so how high can it go? Okay, tomorrow, basically a no-brainer. Another 25 basis point is done deal. Okay, we expect you'll hit about 4.75, and there are still no certainty whether the interest rate will hit the 5.25%. All right, because at the present moment, based on the latest probability, it looks like it will be peaking at 5%. All right, but there is no majority consensus. The interest rate you stay there, and if you look further than that, by end of the year, they don't even have any confirmation where the interest rate will stay. All right, it very much depends on economic situation. If we are going into the severe recession or softening of the U.S. economy, U.S. Federal Reserve, they may stop the interest rate hike and also maybe stay there for a while before it coming down. So in short, it is expected the interest rate will peak in 2023 and you start to fall. So that will give a big boost to Singapore REIT and also the bond. Ian talked about bond, all right? Bond has an inverse relationship of the interest rate. Okay, so some of the things I'm watching out in 2023, because in view of the fear of global recession and also in view of the interest rate coming down, so we need to be selective, all right? So I have give my market outlook on the business time 1 week or one and a half week ago on January 19. If you have a chance, you can go back to the business time to really look at my comment over there. So I just highlight some of my critical comment over there because that will be my view for 2023. I will be okay. First thing first, I will be keeping an eye on the net asset value and also distribution per unit growth trend. The reason being is some of the valuation of a REIT portfolio itself will drop due to the higher interest rate. This is due to the valuation model. When you are using the higher cap rate, basically your valuation of portfolio will drop. Okay, so some of the REIT will be affected, some of the REIT will not be affected. So this is one of them. And distribution per unit is very much depends on how the REIT manager can navigate through the high inflation and also high interest cost spent on their portfolio. So some of the REIT, the management team, they are not really doing a good job or they're not experienced enough. You can see that actually they will have a drop in the DPO. But some of the REIT itself, they will not have any drop in DPO, in case they have a growth in DPO. So it's very much depends on the REIT manager experience and also their firepower. Okay, another area I will be paying special attention is how the REIT manage their debt. Right, we need to look at the gearing ratio, interest coverage ratio, debt maturity profile, current interest rate cost, and also secure borrowing. It's not as simple as you just looking at gearing, dividend yield, and also price to book. It's not as simple as that. 2023 will be a very special year because we have two challenges. One challenge is we may enter into the recession, right? The other challenge is they also need to deal with the high interest cost. Okay, these two elements will impact their dividend payout. Okay, so we need to see how they manage it through. And the third thing in my outlook will be which sector will be start to performing well, and most likely the retail sector and also hospitality sector will be doing very well because of the China reopening. The China tourists will come into Singapore, and after 3 years of the COVID lockdown, there would be have a revenge traveling and also revenge spending phenomenon. All right, all of us have been locked down for 2 years. All right, and after the border reopening, all of us just travel. We don't really care about the hotel room rent or even the high price of the air ticket. We just want to get out of Singapore. This thing will happen into China. You just look at the population of China. Singapore is just so small. We want to go up, and China, the population is so big, and they will have a big impact and big influence in this whole world economy moving forward. So who knows? China reopening can be the saver to really turn our global economy around. Okay, case study. Okay, I will use a case study to explain why some of the debt management you have to pay attention to. Okay, I'm using the ECU as a case study. All right, if you look at all the fundamental ratio, typical investor, basically you are just looking at a yield or 12%, very high yield, very good. All right, and much better than your T-bill, much better than your SSB, much better than bank interest rate, 12%. Right, and also undervalue, and also high yield. When you come to the property investment, you want to look for property undervalue at the same time, also giving you a very high yield. So it's a no-brainer. It's a good thing to buy. But if you forget to look about the debt management itself, all right, WADM stands for weighted average debt maturity. That means that in less than 1 year, they have to refinance the debt. Okay, 0.7 maybe about 6 months, 7 months, they have to refinance the debt. Okay, and when they refinance the debt under the high interest rate environment, okay, most likely they'll be refinancing at a very high interest rate. And at the same time, if you need to refinance at a very high interest rate, you may not be able to pay your mortgage liability, right? The interest coverage ratio, you give it some indication, right? At the same time, the weighted average of the lease expiry is getting shorter and shorter. So under the recessionary environment, your tenant may not want to renew the lease, and that will create the pressure on the occupancy rate. So everything linked to each other. All right. So in terms of the debt management and also balance sheet itself, EC World is a very risky REIT to invest, although they are showing you very good financial ratio. Okay, basically, last year, around this period, January 16, 2022, actually, I have already issued a sell recommendation to my client itself to sell all the EC World holding. Okay, I basically, at that point of time, EC World was trading at around 72 cents, right? I sold everything. I listed the reason why we have to sell the EC World. At that point of time, EC World, the debt maturity profile is only 0.88 years. And they have to refinance a debt in the near future because there was no choice. And also the financing cost is 4.1%. And also there is a risk of EC World being unable to refinance the debt. And it did really happen now. They are not able to refinance the debt. And they have to sell away their property. Okay? So, or sell away the property or they have to issue right. So there are a lot of risks in the EC World itself. And what happened now? Okay, during that time, I just issued a sell call over here. And at the present moment, based on the yesterday closing price, EC World has dropped close to 37%. All right. So if you don't pay attention to it, you will lose in the capital. And until this morning or yesterday, January 30th, they are still not able to refinance the debt. They are also not able to sell away their property. Okay. So I do not know how long this saga will go to. That will possess a very big risk to the investor itself. All right. If they are not able to refinance, they are not able to sell, and they are already reaching the gain ratio anytime, that can be in the default mode. Okay. Why I say that they can be defaulted? If you look at the unsecured borrowing, is 0%. Basically, it's something like our residential property. If you borrow money from a bank to buy the residential property, the bank has a first charge. If you are not able to pay a mortgage loan, bank can take over your property anytime. It's exactly same as the EC World. If the bank take over their property, but when they're announcing default, and that's it, and finish on this rate. So there is a huge risk on EC World itself if they are not able to do refinancing. Okay, so that's why debt management is very, very important. So pay special attention to the capital management or debt management due in this 2023. Another case study will be the CapitaLand Ascot Trust. Okay, if you look at all the financial ratio, looks good and also very well diversified. And if you look at the price to NAV historical chart itself, actually I did issue a buy call during this period. After the rebound, sometime April 2020, after the rebound, because at that point of time, Ascot Trust was trading -2 standard deviation below the average. So it's a no-brainer because it's seldom trading at this level. Then since then, after that, Ascot continued to recover. So I issue a buy call on CapitaLand Ascot Trust on April 17, 2020. Okay, and that at that time, the share price only 90 cents, right? Of course, I put in all the reason here why we need to enter at a place, right? For the client who follow my advice, basically, they have the total 39% return over a 2 to 3 year period. Because based on the share price itself, the share price has climbed up from 90 cents to 110 today. So there were 29% capital appreciation and also holding for 2 years close to 10% dividend. So total 39% dividend, total return. And it's expected Escort, you continue to climb due to the China reopening, right? And the latest earnings announcement on January 30th, yesterday, not surprise to me, maybe surprise to other people. The second half DPS distribution per staple security raises 47%, right? And they are expected to continue to improve or increase their DPS with the China reopening. Okay, third one, Manulife. Manulife also yield is very high, and due to the high cap rate used in the valuation, the whole property value dropped a lot, and now Manulife is at the risk of breaching the 50% gearing limit, right? They got no choice; they have to do something on this gearing limit, right? Otherwise, they may not be able to refinance the debt, or they are not able to do a lot of things moving forward, all right? But if you look at all the other debt management ratio, it still looks healthy, okay? And this is a killer. So next week, Manulife will be announcing giving a business update. Okay, if you are holding the Manulife REIT, I would strongly suggest that you pay attention to it, because there will be a series of action plan. How are they going to reduce the gearing? There are a few possibilities. One possibility, you'll be selling away their property. Once you sell away the property, the yield will drop. Okay. The other possibility, there'll be issue right. Once you issue right, the share price will plunge further, then you lose even more money. Right? If you sell, so there are few alternatives being bring out, and it may affect you or may affect the rest of the investors. So this will be a very interesting thing moving forward. And it is not surprisingly, Manulife, you enter into this kind of situation, because if you look at the NAV itself, it has been on a declining trend since 2018, right? The valuation keep dropping and dropping and dropping and dropping, right? So this is not surprisingly. And also although the price to book looks attractive, now at the present moment is also very cheap, right, in terms of valuation. And the share market, the share price has reflected something we don't know, right? The announcement only happened somewhere end December. Okay, basically December 30th itself, they have an emergency investment update. They call me and also call the rest of the analysts to attend the so-called last minute update at the end of the year, because they said that they cannot wait until the year open. They have to make an announcement before the end of the year due to the huge drop in the valuation. So actually, the announcement only happened here. But if you look at the share price itself, the share price has been on a declining trend, and since quite some time ago. So there's something we don't know, but the market already know that. Okay, something is brewing. Okay, so you can look at the news paper itself. There are certain search in the Manulife gearing at a defining moment for a manager and a sponsor. So this news create a lot of fear to the US, to the Singapore REIT with a US portfolio, all right? And I can show you what happened on the portfolio valuation for Manulife itself. You just look at this. These are all the property the Manulife currently is having. You can see that some of the valuation can drop up to 33%, right? But across the board, all the value of the property drop, right? So all in all, the whole portfolio valuation dropped by 10.9%, and also the net asset value dropped by, I think, around close to 20%. So it's a huge drop. And this huge drop create a fear to the S-REIT with Singapore US portfolio. You can see that Manulife US REIT, Keppel Pacific Oak REIT, Prime US REIT, ARA Hospitality Trust, United Hampshire US Trust, the yield are very attractive, 16%, 11%, 13%, and ARA just recover 4.6%, 11%. And if you look at the valuation itself, it's a huge discount. So at the present moment, the share price oversold. So what I'm looking at is whether all this REIT, the earnings will be coming out in the next few days or next few weeks. All right. I want to see whether they exhibit the same pattern as Manulife REIT, right? If they exhibit the same pattern, the next thing I will look at what is the share price reaction, because I want to see that whether it has already priced in. My thought the current share price has already priced in the worst. Okay. If any news come out or earnings result come out better than expected, they may stage a strong rebound. Okay, this is what happened to prime US rate. That's why I just show you at the beginning of the slide that rebound up to 20%. Okay, so if you want to, I explain all this valuation thing in detail in my radio interview. So you can scan this QR code because you'll be directed to this radio interview. There are series of the radio interview there. You just can listen on another aspect on the 2023 S Street market outlook. Okay, I'll pause here for a while if you want to scan this QR code. I'm not able to cover so many things, so I just pick up a few key points to share with all you here. All right, and the latest capital REIT earnings, okay, provide some insight on the valuation. So investor fear across the board, okay, maybe the valuation of the S REIT you drop a lot, right? Surprisingly, based on the latest capital REIT earnings, if you look at the Singapore portfolio itself, Singapore portfolio actually has increased in the valuation, right? This is a June 2022. This is the December 2022. You can see that all the portfolio increased. And just pay attention to cap rate they use, 3.something%. So in short, Singapore sector, the valuation is not really affected by the interest rate hike too much. Okay, because the occupancy rate is still healthy, the rental reversion is still healthy. Okay, and the cap rate is not so aggressive. But if you compare to the other country, okay, same thing on the capital rate, because capital rate has overseas property. You can see from here that Sing dollar, June 2022, December 31st, almost across all the property, overseas property, they have a drop in the valuation. And you just look at the cap rate. The cap rate used is much higher, right? So if this is true, I expect all the overseas property, that means all those in Australia, in US, with such a high cap rate, you cause the valuation to drop. So what would be the S REIT investing strategy in 2023? Okay, I just want to show you this asset class return over the years to show you that REIT is cyclical. So do not really need to worry too much if you're investing in a REIT, because at the end of the day, whatever goes up will come down. Whatever goes down will come up. You just go back to 2028 when the REIT sector have a minus 37% drop. The next following years, right? In 2029, 28%. 2020, 29, 8%. 8%, 19%, 2%, 28%, 2.8%. Basically, if you are able to, or you have the gut strong enough, your heart strong enough to invest during the bear market, you will be rewarded handsomely for the next few years, right? And at the present moment, 2022, we have a minus 24%, one of the worst performance of all the asset class. If the pattern repeat by itself, will we see another big bull run coming along, right? So it's all up to the investor to decide whether this is the year 2023 is start to do the accumulation. All right, this is based on the past performance. And at the present moment, the yield is pretty attractive. If you look at the top 20 REIT itself, it range from 16% to 6%, right? Depends on the risk appetite. Some of them good, some of them bad, some of them is very dangerous, right? And if you look at the valuation itself, the valuation is not expensive. It's pretty cheap, and it's closer to the 5-year PNAV value. It's very, very cheap. So if you are able to pick up some gem, okay, you'll be locking in a very low price. At the same time, you're enjoying a very high dividend yield, and that will really shorten your investment horizon a lot if you're building for your retirement. So a summary for the 2023. So probably interest rate has already peaked, and rotation may back to the S REIT. Okay, so far after the first month performance of the S-REIT, it looks like it's really back to S-REIT is back. And the best time to accumulate the REIT is when valuation is cheap, because at the end of the day, we are investing in real estate. If real estate who can give you a very good dividend yield, can rent it out, there are a lot of traffic, and they're telling you, I am 20% discount now. If you don't want to buy a 20% discount, when do you want to buy? Do you want to wait for everything to go up before you buy? Right? It does not really make sense. So valuation is cheap now, and also need to make sure that distribution is sustainable. Okay, so REIT selection is the key. It's not across the board. All right. So investor, I suggest to pay special attention to the capital management. Okay, so this is the right time, and it's important to make the right decision. Okay, time is right now. The key thing here is what decision you're going to make. You really determine whether you can shorten your accumulation period, or you need to work a few more years before you can accumulate enough passive income for your retirement. So time is key. And okay, I have shown a lot of analysis. Okay, so those are from my old REIT screener. I have my own REIT screener that will help me to speed up my old the whole analysis. I will be launching a new REIT screener, right, which will have a lot more information, and I will use the new REIT screener to help to teach in the SGS Academy course. So there are a lot more information over there, but the REIT screener is not ready yet. So if you want to have a first-hand information, or want to be the so-called first mover to use this REIT screener, you can scan this QR code and also put yourself in the waiting list. So when I launch itself, you are able to sign up this subscription immediately. Okay, I'll pause here for a while if you want to do this scanning a QR code. Okay, next. Okay, although REIT at the present moment represent a good entry opportunity, but always manage your risk. Make sure you have a diversified portfolio. Okay, to diversify the risk away. Nobody can guarantee that interest rate will start to come out this year. Okay, there is a high probability, but suddenly if inflation come back, Federal Reserve decided to really increase the interest rate to maybe 7%, 8%, I can tell you, REIT will crash. REIT will crash. So there are risks involved. So REIT is just a small sector in the whole investment space. It very much depends on your risk appetite. Okay, there are some asset class which give you high return, high risk, and some of them will give you low return, low risk. You need to define your objective clearly, and you also need to understand your risk profile plus your holding horizon. And from there, you pick some of the relevant asset classes. For example, just now you mentioned, Ian talked about corporate bond. They also have a bond fund over here. You can use a cash, SRS, or CPF OA to invest. So there are many instruments out there. The key thing here is how many of them you understand and how to assess them. Those are the key questions. So if you want to have a more diversified portfolio, you want to know what kind of solution out there for you to build up the diversified portfolio, you can contact me. This is my contact number. All right, and I'm offering the REIT advisory services, because if you do not know how to build a REIT portfolio, or you need someone to review a REIT portfolio, remove all those lousy REIT, and also put in those very strong fundamental REIT for your long-term retirement purpose, okay, I can help you to take a look, right? At the same time, if you're holding a lot of other investment, right, all the top-line investment, you do not know what to do, because last year was a very bad year. Basically, most of the investors lose money. You will invest in equity, invest in bond, invest in anything, also lose money last year, right? But you do not know what to do. You want some independent third party will to tell you, okay, this investment you should sell, that one you should accumulate. Whether you are having a lot of risk in your portfolio yourself. If you need an investment portfolio review, you can also approach me. At the same time, I also provide the retirement planning services, insurance portfolio audit. If you're paying a lot of insurance, you don't know what you're paying, and you do not know whether the insurance you're buying now, actually do you really need it? You need have an independent review. I can help you to take a look. right? And lastly, I also provide the services in terms of the estate planning and also business succession planning. So my email is over here, and this is my contact. All right, that's all for my tonight sharing. Okay, over to you, Richard.
Okay, wonderful. Thank you, Kenny, for your generous sharing. And for all the attendees who are still with us, if you have questions for Kenny, please type into the chat box in the bottom right of the screen. If you're using a desktop computer, or you may need to scroll up or down if you're using a mobile device. And please type in your questions now while I ask Kenny a few questions. Okay. So one of the things that we always do is to put on a disclaimer saying that if you are in doubt, or if you when you have questions or not sure, please seek professional help, right? So every speaker or presenter will put a disclaimer like that. And guess what? Kenny is the professional help because he is a licensed MAS licensed financial advisor, and he is able to give you advice based on your needs. So please feel free to contact him for all the needs that you see on the screen right now. If you know what to do, you can DIY. That's perfectly fine. But if you are lost and need to get a second opinion, then Kenny is the professional help that you can get from him. All right. So please contact him at his email address you see on the screen, or the QR code for the services that he offers that you see on the screen right now. And while the questions are coming in, Kenny, just now you mentioned about cap rate. What is cap rate?
Okay, cap rate is another word for as something like an interest rate, right? But in the property investment world, they are using something like property yield, right? From there, they can derive at a cap rate.
So is a higher cap rate better or lower cap rate better?
Higher cap rate, you end out you have a lower valuation. If you look at the how we calculate the intrinsic value for all those value stock, you have the you do the future cash flow discounted to current value, right? You have a numerator for your future cash flow. This you have to discount to the present value. That's your denominator, right? You go back to formula, then you understand what I mean.
I see. So higher is better, is it?
No, higher the valuation will drop.
Oh, higher the
Okay.
valuation will drop.
But
Okay.
also think of another way, all right? So at the present moment, you can see that actually US is using over 5%, right? But we know that moving forward, interest rate is coming down. There can be another direction. If suddenly the interest coming down, you use a lower cap rate, you end up your valuation value go up.
I see.
It can change very fast. That's why it's very much depends on the interest rate. So Singapore cap rate 3 point something percent, US 5 point something percent. So investor need to think, is 5% make sense or not? Right? 5% can be very conservative, right? But every country has their own cap rate if you compare to the property yield at their region.
Oh. So who decides the cap rate? Is there an authority or the company themselves, or is there independent valuer?
They always use an independent valuer, right? And also when they determine all this kind of valuation, there are typical two model. One is comparative model. They just look at the surrounding property, look at the past transaction price. They can determine what value to use, and at the same time, the other valuation model, you look at your future discounted cash flow. Future discounted cash flow is very much depends on occupancy rate and also your rental reversion, right? Then you have a year 1, year 2, year 3, year 4, year 5. That means you just bring all the future rental cash flow to the present value and divide by the cap rate.
I see.
Right,
So,
but that one you determine on the occupancy, right? So for Manulife case, that's why I say that it may be overblown and also oversold, because the valuer use a very high cap rate, 5 point something percent. And at the same time, because Manulife has 2 tenants moving out, and the assumption is the valuer make assumption the valuer the tenant may not coming back. All right. So if they are able to really solve for the new tenant and as everything back to normal, your valuation will change again.
I see. And how often do they do that? How often do they
Normally
revise?
once a year. Normally once a year. But they can
Right.
do it maybe half a year if there is a drastic change in terms of all this kind of macro environment.
I see, I
situation.
see. Just now when you show the Singapore valuation increase, but the overseas one drop. So would it come a time that, you know, it'll be Singapore's turns where the valuation drop? Or you think that that's not likely to happen for Singapore's case,
I
for
think
Singapore
for
properties?
Singapore case, unlikely to happen because all of us, most of us have a mortgage loan, right? I think the government don't want to the property sector out of control. In Singapore, property sector is in a control manner.
I see. Okay. Great. That's the questions I have. And let me now turn to the questions from the audience. Okay. James is asking, hi Kenny, what do you think of Keppel DC's REIT at the current price levels?
Okay, I have a screener. Okay, I just come back on my mind. If you compare to the historical, okay, let me look at screener first. Keppel DC. Based on the valuation itself, Keppel DC currently is trading -1 standard deviation away from the historical average, right? But Keppel DC always trading at a premium. At the present moment, if you look at the historical data, it's still trading below the premium. So that's one thing. And also Keppel DC at the present moment, the yield is around 5%. It's very rare Keppel DC can be traded at this level since the IPO. That's one thing based on the valuations point of view. And also the debt management looks okay. And long-term wise, it depends on whether you believe in a data center or not. Okay. If you believe in data center, you grow, then maybe it justified this kind of premium, then you can accumulate lah. If you don't believe the data center can do well, then you don't invest. It really depends on what's your view on the data center, because there's one shorty from US one that don't believe in the data center. They say that data center eventually no business, something like that.
I see. Okay, James, I hope that answers your question. The next question comes from a few persons actually. They are asking about the Maple Tree Group. Yeah. So the Maple Tree Group, what is your opinion on the Maple Tree Group? Their returns doesn't look attractive, but they are like better, you know.
Yeah, I saw the question. The MIT and MLT, the NAV dropped by 2 to 3%. So one very important thing investor must take note and also must differentiate what is a trend and what is the noise. Statistic. What is a trend and what is a noise? So noise, it can be plus and minus 5%. Trend is consistent, right? Because along the way there will be a lot of changes, because there are a lot of moving elements in terms of NAV itself. NAV also depends on how much cash flow you can receive. At the same time, how much you'll be impacted by inflation, because they have to pay for utility costs. At the same time, they also need to pay for the interest expense. And at the same time, also because of inflation, your labor costs will also increase. And you have another thing is a number of share, right? And MIT, and they also have a dividend reinvestment plan, whereby the investor can choose the shares over the cash dividend. So there are a lot of moving elements, right? So for me, all 2 to 3% that kind of valuation drop, to me, I'm not really a concern, because at the end of the day, I am looking at a strong sponsor. I'm looking at track record to see whether they are able to generate the long-term growth in NAV and also growth in DPO, because interest rate will not stay long forever and inflation will not stay long forever. They have a hit for the past 1 or 2 quarters because of higher inflation, higher interest rate, does not mean that they're going to have a big impact moving forward. So for me, I'm looking at long-term plan. And also, of course, you have to focus on the objective. If your objective is to build a diversified portfolio with a lot of strong sponsors, strong REIT, all these things is not really a major concern, because especially at the present moment, the valuation, it looks attractive.
Okay, great. Thanks, Kenny. And I hope that answers your question for those of you who asked about the maple tree counters. Now, several of you are asking very specific questions. Oh, should I buy this or should I sell that? I think those questions Kenny cannot answer on a public webinar, because he has to understand your needs first and your objective. So if you have those very specific questions about whether you should buy or sell because you have made money or lost money, please contact Kenny directly. His QR code and email address are on the screen right now. Please feel free to contact him. All right. So let me see. Along the line of data center, there were a few questions regarding whether DigiCore read, and then whether is it worth, is it good, and then Mapletree Industrial REIT, Industrial Trust, compared to Kappa DC, compared to Digital Core. So all these three have data center elements to it. So, what is your opinion on these three data center REITs?
It still come back to the personal own objective and also your risk profile itself. Because if you're looking at MIT, around 50% they are data center, and another 50% you have a business park, you have other industrial building, right? In terms of diversification, they are much more diversified, right? But in terms of growth element itself, of course, at the present moment, the data center, you have a higher growth. And Kappa, you have to look at the portfolio itself. Where are they located? And Kappa DC, they have a lot of data center in Singapore, but of course, also in other side, they also have a data center in China. And Digital Core itself, basically, I don't think anything in Singapore. They have quite a lot in US, and recently I think I acquired something in Germany or in Europe, right? So it depends what is your comfortable level or where all the property being located, right? If you have much more confidence in Singapore sold property, then you stay with those REIT with a higher exposure to Singapore, right? But at the same time, with a higher exposure in Singapore, your return will drop because the dividend yield will drop. When you move to overseas itself, the return will be higher to compensate all those other risks, right? So the trading currency also important. If you're expecting to get your dividend in Sing dollar, of course, everything traded in Sing dollar, hedged in Sing dollar, you'll be good, right? But if you're looking for, if you're holding a lot of USD, all right, you do not want to convert back to Sing dollar, maybe you just look at those data center which traded in the USD. So you have the regulation risk, you have a currency risk, you have the country risk, you have the property type risk. So it's very much on individual. I can't really give you a specific answer until I totally understand what is your risk level or your risk tolerance, because every one of us will be different, are different.
I see. So I hope that answers your question for those of you who asked about the data center REITs. Yep. Okay, let me see. Okay. Still is asking about your outlook on those REITs with Europe exposure, such as Cromwell.
As long as at the present moment, as long as you have an overseas risk REIT, that the risk will be higher. Okay, because Europe, the current economic situation, I think, is much more worse than US. So they are maybe under the severe recession. Who knows, right? And also Ukraine-Russia war, we do not know when they're going to end, and if they have if they continue the situation continue to worsen, really can bring Europe into the severe recession. And when you have a severe recession, your economic activity, your manufacturing, everything will be affected, right? And energy prices, energy costs, utility costs, it can be quite bad. But on the other hand, also don't underestimate the power of all those central bank. Although the economic situation is very bad, the share market crash or whatever thing, when the central bank they start to decide to print money, that the whole thing can turn, right? So there are a lot of moving element, a lot of uncertainty, and my advice is no point you go and guess what's going to happen, right? For example, Ukraine and Russia war, maybe tomorrow they'll launch a nuclear war. We also do not know what's going to happen. So it is important for you to really diversify your portfolio. Very, very important. Don't need to guess. Diversified portfolio can save you, right? That's one thing. The other thing is, if you want to sleep well and you just avoid those overseas REIT totally. But you cannot run away from overseas exposure because in Singapore itself, our land is limited. At the same time, the good property, most of them are already written. So if you want to have a good portfolio in Singapore, at the same time you give you a higher return in Singapore, it's very difficult to find. So for the REIT, in order to grow their DPO itself or NAV, they have to go overseas. And for example, the industrial space, all the land lease in Singapore is very short, less than 30 years, something like that. But when you have a very short land lease tenure, right? When the times go by, your net asset value will drop because your valuation will drop. So eventually, this is something like depreciation, right? Like buying a car, over time you drop. So those REIT, they want to stop all this kind of NAV drop, they have to go to overseas, because overseas you still can find a freehold warehouse, freehold property. The value can preserve. So lease tenure is also another area investors should pay attention to.
Okay, great. So I hope that answers your question still about the question about the REITs in Europe. Okay, I think we cannot do without a medical REIT question. So Wei Liang is asking about Parkway Life REIT. What might have caused the downtrend price drop back in October? And yeah, so
Yield spread.
okay.
If you look at it, the yield spread at that point of time, I think because 10-year risk-free rate, Singapore government yield, I think at the point of time 3.3%. I think at the top, right, Richard? I think around that 3.3%. And Parkway Life REIT they are merely give a 3 point something percent, and basically you don't have spread.
Correct.
So if you just look at it as an investor, you have a 3 point something risk free, and Parkway Life give you 3 point something got risk. It's a no-brainer for the institution investor that move away from Parkway Life to park somewhere risk free first, right? Then after that, the rebound because the yield spread widen. Fundamentally, nothing wrong with Parkway Life because everything is very strong. But when you talk about the yield spread or a risk premium, it does not really make sense to invest in Parkway Life.
Okay, wonderful. So Wei Liang, I hope that answers your question. Another question is about first REIT. I think this will be the last question for Kenny. And that is on the Guan Yu, I believe, is asking for your view about first REIT. I think it has not historically, but moving forward, because there seemed to be a change in their strategy.
Yeah. It depends on whether you believe in their strategy 2.0, growth 2.0, I think, right? Because growth 2.0, basically, they diversify away from the hospital in Indonesia. They want to acquire more nursing home and hospital in the developed country, which means that Japan and also in the Australia. It very much depends on whether you believe them, they can execute their strategy well and also can really diversify away from Indonesia, right? So it's a story. So far seems that they are executing, and so far there seems that they are delivering what they promised. But whether this trend can continue, nobody knows. All right, so that's my view on the first REIT. So you have to judge your risk. If you strongly believe it, and at the present valuation, compared to Parkway Life, because first REIT also use a Parkway Life REIT as a benchmark, as a comparison, right? So if you believe them, they can do well, there is a huge upside potential, right? But if the execution fail, if they fail in the execution, right, and they're back to square.
Okay, wonderful. So I hope, Guan Yu, that answers your question about first REIT. And with that, will be the last question for Kenny. And thank you, Kenny, for your very generous sharing and taking so many questions from our attendees. And do you have any last words for our attendees?
What Warren Buffett said, that be greedy when everyone is in fear. So I use the past two market crash, okay, especially when the PNAV around 0.8 I shortened my retirement accumulation period but a lot right? That's I think I need to say. So this is another golden opportunity for accumulation if you have a strong heart to do the accumulation, right? But you'll be rewarded over the long term because this is the best time for you to really lock in a high yield at a cheap price for Singapore REIT. All right.
Right.
So safe investing and good night to everyone.
Yeah, thank you. Thank you, Kenny. So for those of you who have still got questions for Kenny or need help with your looking at your financial portfolio, please reach out to Kenny directly by emailing him or scanning the QR code. And with that, we have come to the end of tonight's webinar on OTCS Market Outlook 2023. Thank you for your patience with our technology issues. And please join the respective Telegram channel so that you can be kept posted of all the various activities from our various speakers and from our sponsor as well as OTCS. And I'll see you at the next webinar. Good night, everyone. Good night, Kenny.
Good night.
Bye.
Bye-bye.